We are our strategy, and we translate macro signals into probabilities, not predictions. Direction suggests dollar pressure, magnitude could be meaningful, relationship runs through policy coordination. The implication is that currency risk may no longer be passive. The source describes a subtle signal from deep inside the dollar system. If accurate, direction points to preparation, magnitude is nonlinear, relationship is coordinated action. This matters now because currency regimes usually shift suddenly, not slowly. The video frames this as a potential Plaza-style reset. Direction is a weaker dollar, magnitude could span years, relationship ties, debt, trade, and policy. So what changes is how we think about cash, inflation, and what gains really mean. We run this through labor, credit, yield direction, liquidity plumbing, dollar funding stress, and market breadth. Direction suggests global funding pressure could ease, magnitude depends on follow-through. The implication is, risk assets can rise while real purchasing power quietly falls. This is happening because high debt becomes harder to carry when rates stay elevated. When that happens, governments often let money buy less instead of cutting spending. That keeps the system running, but shifts the cost to savers over time. If policymakers guide the dollar lower, global dollar stress can ease. When that happens, forced selling pressure often drops first outside the United States. This is why emerging markets sometimes stabilize before developed markets do. Currency intervention often behaves like liquidity injection. When liquidity rises, markets can move higher before fundamentals improve. That is why rallies in this phase can feel strong but unstable. A weaker dollar raises the price of imports. When that happens, inflation expectations can rise even if growth slows. This is why long-duration assets can remain volatile. Households feel it through higher prices before wages adjust. Import-heavy businesses feel it through margin pressure. Markets feel it through dispersion, not uniform gains. If this way of breaking macro down is useful to you, we publish these signal-based updates as conditions change. You can subscribe if you want to track how this evolves with us. This behavior aligns with Phase 2 in our framework. That is where durability matters more than upside. Policy shifts towards survival rather than optimization. We would look for coordinated language across central banks. We would look for unusual currency operations and funding relief. Without those signals, this remains a scenario, not a regime. One quick clarification before we close. We are not verifying private desk calls or giving financial advice. We are mapping scenarios and watching confirmation signals. Debt math did not change. Inflation sensitivity did not change. Policy trade-offs remain binding. What changes is how safe cash feels in real terms. What changes is how nominal rallies can mislead. What changes is the importance of liquidity over headlines. Our takeaway is conditional, not dramatic. If currency becomes a policy tool again, purchasing power matters more than price levels.